To start off with, my name is Anurag Rana. I'm a technology analyst with Bloomberg Intelligence. I spend my daytime looking at technology companies from Apple to Microsoft, AWS, and then the whole plethora of them. Let's start with an introduction of our guest, please, Anastasia.
Sure. Anastasia Amoroso. I'm the Chief Investment Strategist at iCapital. For those who maybe are not familiar with iCapital, we're an alternatives fintech company, a marketplace for alternatives. So in my role, I spend time thinking about the macro universe out there, growth, inflation, risk, central bank policy, fiscal policy, and what impact does this have on various alternatives asset classes, private equity, private credit, real estate, and more. We do also have a structured investments business, so I can't avoid public markets either. So I'm sure we'll talk about that as well.
Good evening, everyone. Thanks for having me this evening. I'm Chris Roth. I'm the Chief Investment Officer for global fixed income for Northern Trust Asset Management. Many of you may well know Northern for its 135 years. Here headquartered in Chicago, we manage $1.3 trillion in assets under management within fixed income, $160 billion, and including liquidity, $475 billion.
Matt Stucky, I'm Chief Portfolio Manager for Equities for Northwestern Mutual's wealth management company, our retail offering. We just crossed $335 billion of assets under management, and given the volatility of the stock market, I think we're looking forward to the conversation today.
It's fun to see these so many billions and trillions are just flowing through right now. So, one of the first important questions right now is when you walk into a year, everybody has an investment outlook. So let's start with that, a common question for all of you. What was your investment outlook when you started in 2025, and has anything changed since then?
I'm happy to start. We titled our investment outlook for the year of solid underpinnings and plenty of wild cards. And I sort of stand by that right now. And, the solid underpinnings that we were talking about is the U.S. consumer that finished the year of 2024 on solid footing and seemed like was heading into this year on solid footing as well. I personally would argue that despite the consumer confidence numbers that we're seeing, we're actually still seeing spending growth running 3 or 4% year over year. So I don't see a massive problem with that solid underpinning. We talked about the solid underpinning of deregulation, and maybe we have to wait to really see, the fruits of that labor. But then there's also one that I'm still equally encouraged about, which is the growth in productivity that we've actually seen in this economy. And if you think about the last 5 years, U.S. productivity growth has increased by 2.1 percentage points on average, which is well above what we saw in the prior 5 years, where we saw 1.4% productivity growth increase. So whether it's COVID, whether it's AI investments, but I was encouraged by productivity growth also giving this economy resilience. Now, none of this has changed, but what we also said in our outlook is that while those 3 or 4 factors that I outlined are positive for risk assets, what's ultimately going to determine the outlook is the wild cards, which is taxes, which is tariffs, which is fiscal policy, the pace of rates, and also, by the way, big tech regulation. And so when we sit here today, it seems like the wild cards are certainly whipsawing the markets around and certainly determining the outcomes. I would agree as kind of a bottom line with Amy that I think this market is still investable. I think this market can still, for the full year 2025, generate positive returns, in my view, because, we have 13% earnings growth. We didn't wipe all of that out. Maybe we shaved off 1% or 2%, maybe it's 3 or 4%, but we certainly didn't wipe all that out. But it is a market that is more difficult. The upside is likely more capped, and therefore we have to be more discerning investors.
Chris, what about yourself?
We go through 2 processes in parallel as we come towards the beginning of the year. One is our 10-year capital market assumptions, where we're trying to think big picture, long term, more as a buy and hold investor, and at the same time trying to think tactically about the year ahead with a base case scenario and 2 alternative or risk scenarios. And the base case scenario, for many of the reasons that Anastasia put forward, we're very much towards the fact that we are in a mid-cycle adjustment, that the economy is slowing from a period of intensely rapid growth followed by relatively, intense restraint, and that as the Fed began to take its foot off the brakes, that the economy would stabilize at some area near growth in both, or near trend in both growth and inflation. Many people call that soft landing. It could be that if we hit soft landing in 2025, it will be Goldilocks, and so that's where we started the year. And while there's a lot of volatility in the market, we're still holding to that as the baseline.
Yeah, I would agree with that, Chris. We started this year with the view of to be a little bit more defensive, just given the starting point of valuations. And as a reflection of that, we looked at the investment-grade credit markets, and those were signaling kind of 25-year tights in terms of the compensation you would get for absorbing that credit risk. That translates into high equity valuations. And on a go-forward basis, that means your upside, to your point, Anastasia, is likely capped, probably more likely reflected in terms of what ultimate earnings growth you get if nothing bad happens in the economy. That forces that multiple lower for spreads to widen out. We are seeing some of those kind of wild cards come into the marketplace, causing uncertainties to move higher. And with that, we think investors are best served to really embrace diversification, whether that's here in the United States and smaller and mid-cap asset classes or outside the United States, areas that haven't kept up with the QQQs as well as the U.S. large-cap asset class. So we're sticking with that posture as it is now. We want to have a lot of embedded hedges within our portfolios for our clients. And that's how we're going to continue to navigate this until we get some more certainty.
Matt, we were discussing this a little earlier. The 1Q GDP numbers are trying to be revised downwards or trending downwards. And, does that change your outlook for a healthy growth for the full year? Or are you still seeing, some kind of improvement or a continuation of a good economic growth?
I think that's started to catch some investors off guard. If you looked at where we ended the year, the consumer spending was at a high note, year-on-year growth of north of 4%. But that started to pull back a little bit. You saw the January retail sales slip into negative territory. That could be weather-related. That could be wildfire-related out in Los Angeles, unfortunately. But what I think is also a risk is the policy uncertainty. Since the October levels, policy uncertainty has 4x'd since then. And those types of shocks can cause a pullback in consumer and business spending. Whether or not that's translating into GDP estimates via the Atlanta Fed that's pulled lower or not, we'll wait and see. But it is early in the quarter still from a data perspective, and so those numbers can adjust around. But ultimately also within the trade component of GDP, that's really pulling the estimate down for this first quarter. And what's interesting, if you kind of read through some of the Atlanta Fed data, what's really driving 60% of that gap out in terms of the trade deficit is gold imports. Gold imports don't have much of an impact on the economy nearer term. And so if you adjust for that, if you adjust for some of the strong labor numbers that we saw last Friday, we're actually slightly in positive territory, which is encouraging.
So, Anastasia, you talked about consumer spending slowdown.
Yeah.
I mean, in the last 3 weeks also, we're just seeing, negative pre-announcements from Walmart, and Amazon's just been, declining. Do you see any structural change in that thesis, or you think it'll just adjust itself back?
I don't, not yet. And, to Matt's point, we had consumer spending that was incredibly robust to finish the fourth quarter of last year, running around 4%. And I think some of the slowness that we're seeing today is the give back of the fourth quarter that we've had. You also can think about consumer confidence, and on the surface, the slump that we've seen in consumer confidence, maybe it tells you, well, consumers are not going to spend as much. Well, maybe. That's a question mark for me, because if you look at consumer confidence, it's really been in this wide but depressed band since about 2022. And despite that, not just seasonal, but perpetual depression that we've had, consumers continue to spend. So I don't necessarily see the GDP report or the consumer confidence or maybe even some of the guidance from retailers telling me something new. When I would start to worry is if the labor market starts to crack. And, when the private side, I don't really think we're there yet. We had a strong payrolls report. We still have profit margins. They're near record highs for now. So I think all of that is intact. But I guess on the margin, I do worry about what does DOGE mean for the labor market, and not just on the federal level, but what does DOGE mean on the labor market on a municipality, on a local level. I had dinner with somebody last night who is a local mayor for, a municipality in Florida. And she was telling me how you do a project and you expect that a part of that project is going to get reimbursed by federal funds. Well, there's a huge question mark about not just that project, but many others. And do you go and pursue it, even though you're not sure whether you're going to get the funding from the federal government or not? Or do you halt it? Do you stop it? So, so I worry that will over time start to weigh on the consumer. So when we're picking spots to invest, probably consumer discretionary names is not going to be top of the list there.
Fair. Chris, one of the things that has concerned me, even though I'm a tech investor, is inflation and tariff because of tariffs and what the impact of that would be on rates. I care about it because the discount value of future cash flows for tech companies is highly dependent on the interest rates. What are you telling your clients with this risk of inflation coming back back in the system?
I think there are a couple of points that are worth making. One is we are in a period of intense tariff uncertainty. We saw that today in terms of potential tariffs that could have come in place and did not come in place. And so we don't know where we're going to go. Our best estimate is that the average tariff rate, which has probably been in the 2 to 4% range for over recent decades, moves to the upper single digits. We probably would have said 6 or 7%. Now we might say kind of closer to 10%. One is to remember that in many ways tariffs are taxes, and it's a question of who the tax is on. Is it on a foreign government, which is clearly the objective, or is it actually therefore a tax on the company that is absorbing or producing the good, or it on the end consumer? And then there's also the element of, we all tend to say all things held equal, ceteris paribus, but they're not. Things change. There are substitution effects that happen. There are impacts that happen in currency markets. We've seen that really dramatically in movements in currencies of our trading partners. And so while we've had a period of time where the dollar, the DXY, has been off a lot, the trade-weighted dollar actually tells a very different story. So our view would be that we get a bump that is an inflationary bump that comes through. If, core PCE is, around 2.6% today, maybe we bump towards the high twos before we begin a trend back down, towards the Fed's long-term target.
And it says the same thing. Do you think that inflation gets passed on to the consumer? I mean, I'm extremely worried about Apple and the iPhone cost going up. I cover Apple, so part of my worry is both on the margin side and the unit shipment side. But do you think the consumer will eat that profit, or the companies will have to eat that up?
Yeah, I think it is way too early to tell. But to your point, you're not alone about worrying the price of an iPhone or anything else, because when you look at the same consumer surveys, you see that the 1 year forward inflation expectations have really spiked, now approaching 4 or 5 or even 6%, depending on the survey that you look at. I think it is far too early to tell what's actually going to be the result of the tariffs. And first of all, there are offsets. To the point, Chris, you were talking about, is it possible that the foreign government decides to eat some of that cost? Is it possible that the dollar appreciates so much that there's not actually an impact to the U.S. consumer? Is it possible that the company doesn't decide to pass on the full, higher cost of goods sold to the consumer? All of these things are still within the realm of possibility. Oh, and by the way, is it also possible that all this is a negotiation tactic, and as a result, tariffs might actually get dropped on both sides? So we just don't know. But I think there's something else that's interesting, and maybe that's part of the strategy. As you might have noticed, President Trump and Secretary Bessent are not overly concerned about the stock market. But you know what they're really concerned about is the level of yields. And another consensus view going into the year is that yields are going to continue to move higher, and the Fed is not going to cut rates. But is there a chance that this administration is using the tariff ping pong and this policy uncertainty to actually drive the level of yields down? It possibly, by the way, this is a total speculation on my part, and possibly force Fed Chair Powell into cutting interest rates. And so if that's the situation that you actually end up with, then maybe the slower economy, this fiscal restraint, does more to reduce inflation than what tariffs could have done otherwise. So I think it's far too early to tell. So
I was just going to, first of all, your questions were rhetorical, but the answers are yes, 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 and yes.
I forgot the questions.
They're all possible. Yeah. I think the other thing is that Treasury Secretary Bessent said we need detox, if I recall the word correctly. We might need a spa or a sauna or a cool down. The idea that the rates were going to go to 5%, we had an economy that was booming. It was hitting on all cylinders. We had year over year, fourth quarter earnings growth, 18%. And so in many ways, these slowdowns, whether they, are engineered or they are a result are actually probably very healthy for the broader economy.
So, Chris, just on that, what's happening to credit quality? What are you telling your investors in terms of, which part of the curve they invest in at this point?
Well, if I move down to high yield to get to kind of where credit is really credit and where you worry about default risks, there's a lot of really great news. The rise of the private credit market, Amy Fall spoke about this earlier, has been an enduring rather than something that might have been seen as more transitory. That has actually done a lot to support credit quality or capital available for the high yield market overall. If you think about private credit as almost kind of small cap leverage finance, it's pulled companies out of the leverage loan market. The leverage loan market has pulled companies out of the high yield market. The high yield market has become larger cap. Companies have become stronger. They have better coverage ratios, lower debt levels. And the percentage of companies that are the highest rated has moved up to record highs. So now the majority of companies in the high yield market are BB rated, and the lowest rated companies, CCC, are half of what they were post GFC. So there's a big positive story to tell there. Obviously, we're in a period of time where we have tumult, and so nothing's immune from that. But I think longer term, the secular story is really strong.
Sounds good. Matt, let's talk about my favorite topic, AI. I spend more time on that than any other word in the last, 2.5 years. What's your take on this entire CapEx boom, bust, training, inference? Where do you stand on that? And, how do you advise your clients which way to look?
Well, I think a lot of investors are responding to some of the volatility we're seeing in the AI stocks so far this year. They've definitely ridden up the most in terms of 2024 and momentum there, and that's come off here in this year. And the question is whether or not is that a head fake or is that the start of something more pernicious? I think really if you want to look at the sustainability of this cycle, you have to start and end with the CapEx announcements and estimates for the biggest spenders in the space. So the 5 biggest are Amazon, Google, Meta, Microsoft, as well as Oracle. And just take a step back and think of where the CapEx number was 5 years ago in 2019. It was a little over $50 billion. This year it's around $317 billion. So roughly a 30% CAGR. But what's the most important number in that is how those expectations for 2025 have evolved in just 2.5 months into this year. They've been revised higher by 20%. So I don't see this spending slowing down this year. The question is, in 2026 and beyond, the sustainability of that profile. It's inevitable that at some point there will be a correction in terms of CapEx spending as we rationalize some of this spending. No tech-level investment doesn't go without fits and starts. But in terms of the near-term environment, it continues to be robust.
Susan, what about you? This is, again, a favorite topic for the, a lot of investors you talk to.
Absolutely. Look, artificial intelligence obviously is the biggest commercial opportunity that we have today, and it's probably the biggest opportunity we have as investors. But I think the way you invest in artificial intelligence naturally has to evolve as we progress in that cycle. And it makes sense that in the initial stages, you invest in the infrastructure layer, you invest in the semiconductors that there's insatiable demand for. But as we progress, and if we actually look at the total addressable market for artificial intelligence, 88% of that is software. So yes, you've got some semis, yes, you've got some services, but actually most of the payoff of artificial intelligence is going to come from software companies. So, the question that I think is in front of investors right now is, now that we've had this pullback in AI names, which spots do you buy? Do you go to the same Mag 7 stocks? I'm not so sure. Because first of all, the Mag 7 stocks, they're not immune from the potential slowdown in consumer demand that we talked about. They're not immune from potential, restrictions and foreign revenue exposure. And to Matt's point, they've ratcheted up CapEx, but you look at a company like Microsoft, and that's your world, but you look at a company like Microsoft and you have not seen the top line growth that's corresponding to that. So I have a question mark whether you go back to the Mag 7, but if you look at some of the software companies in artificial intelligence, You've got multiples that are still significantly lower than where they were at the peak of COVID. You've got revenue growth that I would probably argue is stickier, maybe a better profile in this environment. You know, if you think about semiconductors, they're highly cyclical. If you think about software, higher margins, and those margins don't tend to move quite as much depending on what kind of environment you're in. So I actually think software can be, you know, both the most opportunistic, but maybe also the more defensive part of the AI ecosystem. And of course, software has lower exposure in terms of foreign revenues as well. So I think the mindset about how you invest in artificial intelligence has to evolve.
I would agree with that, Anastasia. And just to kind of put a point on it, you know, the software companies are going to be, you know, designing the products that they ultimately sell out to the broader economy to harness, you know, the power of AI to bring about those efficiencies to companies that are primarily services-based, information-based, knowledge-based, and can use those tools that software companies create through AI-powered technology to increase productivity. That's ultimately what drives sustainability in the AI space, in my mind.
As a software analyst, I'm so happy of knowing you. Chris, we're almost running out of time. Let's talk a little bit about liquidity in the bond market and spreads. I mean, have anything changed for you dramatically in the last, you know, let's say 3 weeks or 2 weeks or 3 weeks?
We haven't seen it in the last 2 or 3 weeks. But I will say something that I've kind of banged on about is this idea that we're going through a secular change in liquidity in the corporate bond market. If you're old enough, there was a time when, you know, equities traded in eighths and quarters, not in, you know, fractions of cents now. We lived in that world in investment grade and high yield for many, many years. We're moving to a world where electronification and alternate pools of capital are bringing us to systematically tighter bid-offer spreads. If you think about investment grade, if you bought a bond and it had a spread of 100 basis points, you probably only need to get paid a small portion, 10 or 20 basis points for default loss. All the rest of it paid you for liquidity. If liquidity improves, if transaction costs narrow, ultimately over time, that's more of a secular trend. Not to negate anything that Matt said earlier, but I think it's a countervailing force that keeps high quality credit valuable for investors.